Today I put $40,000 into 4 stocks that I feel are high risk but high reward. Now these are defense and AI related stocks, and I'm going to show you exactly what I bought, how much went into each, and why I believe these companies could be worth multiples of today's prices in a short period of time. But first, full transparency, I am not a financial advisor, and always do your own due diligence. Also, this stuff isn't my life savings. It's not rent money or emergency cash. This is capital I've deliberately set aside for high conviction swings where the upside justifies the risk. If I lost it all tonight, I could sleep tomorrow night and the night after. And that distinction really matters because over the years of managing my own money, I've learned you can't approach everything the same way. Different goals demand different strategies. So that is why I run 5 separate portfolios. Today we're only talking about a small, somewhat speculative opportunity portfolio. Now, this is where I like to bet on themes I think are set for potential multi-bagger returns. It's not gambling and it's not random. Now, these are situations where I see the risk reward seriously skewed my way, and I'm okay being in early, basically. So since the channel's new, I figured it'd be fun and accountable to make this portfolio public. I will show other portfolios eventually, but we're starting here with the $40,000 one, and that includes 4 stocks. This is real money, so I'll share screenshots so you know it's legit. And here's one of my investing accounts I use so that you know that if these picks go wrong, it can actually hurt. Now, the tool I like to use to separate my portfolios is called TradingView. It allows me to set up separate portfolios, and it also tracks my companies, their financials, technicals, ratings, and all that other stuff. Now, what I like best is that it also offers me one hub where I can see all of the latest news and headlines related to my stocks. Now, the link, if you want, for a free account is down below. So let's get started on the 4 stocks. But first, let me talk about why I'm actually choosing them and the theme I'm going for here in this high-risk portfolio. They fall into some main themes I see continuing into 2026 and beyond. For example, the AI bottleneck is physical infrastructure. Data centers take years to set up. Right now, power grids are strained and chips are actually backlogged. The real edge is in the companies fixing those underneath problems and not chasing what's already 10x'd. Geopolitics is turning chips, batteries, rare earths, and defense tech into strategic assets. And that means more government subsidies, locked-in contracts, and what appears to be long-term demand. Also, as we all can see, national defense is evolving fast, and every military is adapting. So that's 3 major forces converging: AI's physical limits, supply chains as national security, and modern warfare is shifting. All right, now let's get into the 4 stocks. First position is Iren Limited, IREN. The position start size for this one will be $12,000. Now, Iren Limited has a market cap of $13.14 billion and operates data centers powered by renewable energy. The company is headquartered in Sydney, Australia, and this company used to be a Bitcoin miner called Iris Energy. And normally when I hear Bitcoin miner pivoting to AI, I roll my eyes because needless to say, I've been stung before in the past with Bitcoin miners. But Iren actually did something recently. They signed a $9.7 billion contract with Microsoft for 5 years, and this includes 20% upfront payment. Now, this is real money, not a press release about exploring opportunities. And here's what's actually interesting. These guys spent years locking up cheap electricity for Bitcoin mining. Hydro in British Columbia, solar and wind in Texas, and according to some top resources, they're generating power at 3 to 4 cents per kilowatt hour when most data centers pay 8 to 12 cents. Now, for the most recent fiscal year, Iren reported revenue of $495 million. Last quarter revenue came in at $240 million, and the company is profitable. Net income for the fiscal year was $86.94 million, and last quarter showed super strong results with net income of $384 million. That's up 117% from the last quarter. They currently have more cash than debt, with total cash in the latest quarter being $1.3 billion and total debt of around $965 million. The bottom line is, Iren is a profitable data center operator with strong recent earnings, growth, and a reasonable trailing PE ratio of 22. The Microsoft deal works out to about $1.9 billion per year in revenue, and if that holds, Iren is basically printing money. And here's the thing. They're only using a small fraction of their power capacity for this project. They've got nearly 3 gigawatts locked up. The Microsoft deal maybe uses 200 to 400 megawatts when fully ramped. So every additional contract they sign drops almost straight to the bottom line. They don't need to go find more power, they already have it. So let's be real about what could go wrong. If Iron misses delivery timelines, Microsoft can terminate. Dilution is also a thing. They just filed a $660 million shelf registration. They've already raised billions. Every time they need capital to build out more capacity, shareholders get diluted. And finally, a lot of good news is already priced in. Any stumble and this thing drops 40% fast. I feel like if they execute, doubling or tripling is realistic in the next 1 to 3 years. If they don't, I lose 40%. That's the kind of risk and reward I'm looking for in this portfolio, so let's move on. Next up is BBAI, Big Bear Holdings. The starting position size for this one will be 12,000 as well, and this one's focused on government and defense AI out of Virginia. So these guys build platforms for threat detection, biometrics, and supply chain analytics. Basically the kind of stuff that has to run in secure, classified environments where you can't just plug into ChatGPT. The core business has had a rough stretch. Revenue's been shrinking. The stock has really felt like dead money, stuck in single digits for a while. But things are shifting with a couple of recent moves. They closed the $250 million acquisition of Ask Sage at the end of December 2025. Ask Sage is a generative AI platform built specifically for government use. It's already deployed across 27 federal agencies with over 100,000 users on 16,000 teams, including the Space Force and Defense Health Agency. Now that's serious distribution inside the agencies that actually matter. They also picked up some key assets from Cargo Seer in January, an AI tool for cargo inspection and trade risk that uses computer vision to flag high-risk shipments at ports. Now, on top of that, they announced a partnership with the Kraft Group, which includes supply chain transparency work with International Forest Products and a sponsorship deal making them an official partner of the New England Patriots. Financially, the latest quarter, Q3 2025, reported in November, revenue came in at $33 million, a slight beat on estimates, but still down from the prior year. The real positive was net income flipping positive at $2.5 million compared to $15 million losses the year before. Now, a lot of the past losses were one-time items like impairments or fair value adjustments, but their balance sheet got a big boost in January 2026 when they converted their full $125 million of convertible notes into equity. That wiped out the debt pretty much without burning much cash, and now they have more cash than debt, which gives them real room to integrate these new pieces into their game plan. Now, on the management side, the CEO was acting Secretary of Homeland Security during the first Trump administration. He knows the agencies, the people, how procurement works, and that's very important, especially when you're selling into the federal government. I feel like there's huge upside on this one, especially if government spending ramps up, defense budgets prioritize national security tech, Ask Sage integrates smoothly, and that they turn that agency footprint into real revenue. Now that could drive the stock to say $15 or $20, maybe 2.5 to 3 times from current levels, around $5.80 to $6 last I checked. But the downside is also real here. If the core revenue keeps shrinking or contracts stay inconsistent or dilution comes back, shareholders could feel it hard. Share count has more than tripled since the SPAC merger. Competition from Palantir and others is also intense. If the turnaround doesn't click, it could easily fall back to $3 or $4, which would be about a 40 to 50% downside. Now for me, this is a turnaround play in the opportunity portfolio. I'm putting about $12,000 in, which is about a quarter of the $40,000 investment, because it fits the geopolitics and defense shift theme. I want some exposure to government AI without betting the farm on a story that still has to prove itself. Now, if revenue stabilizes and Ask Sage shows traction in the next couple of quarters, I might think about adding more. For now, it's just a measured starter position, we'll say. All right, next up is Applied Digital, ticker APLD, because this has been on a tear recently. Position size here will be 10,000. The stock is up around 50% just in the first 3 weeks of 2026, and it's trading around $38 as of yesterday. Now, 3 weeks back, they dropped their Q2 fiscal earnings, and it was a monster beat. Revenue came in at 126.6 million against Wall Street's 88 million estimate, and that's a 46% upside. Year over year revenue exploded 250% from 36 million, driven mostly by their high performance computing hosting segment. Now, this isn't smoke and mirrors. They've actually locked in about $16 billion in contracted lease revenue over the next 15 years from long-term deals. CoreWeave is their anchor tenant, with multiple expansions happening now totaling around $11 billion across 600 megawatts. Then in December, they signed a $5 billion 15-year lease with another US hyperscaler. And on the earnings call, the CEO said that they're deep in talks with yet another big customer. And it's not the same as the hyperscaler. And he sounded pretty confident it'll close by the end of January. Now, these are real signed contracts, not just pipeline dreams. I actually read their white paper and it was actually really interesting. What makes Applied Digital stand out is how they're building these massive data centers in places like North Dakota and rural Texas, where power is cheap and available, avoiding the grid bottlenecks in hotspots like Virginia or California. Now, Goldman Sachs is projecting a 10 gigawatt annual shortfall in US data center capacity through 2028. With NVIDIA GPUs backlogged and cloud providers maxed out, demand is insane. Applied is capitalizing on that by getting paid upfront during construction from customers like CoreWeave, who reimbursed for fit-outs and build costs, which flowed through as $85 million in Q2 revenue. Then, once the facilities are energized, the recurring lease payments kick in for years. It's like getting compensated twice, de-risking the capex while building a moat. Now, cash-wise, they ended the quarter with about $2.3 billion in liquidity after a big equity raise, though debt is similar at around $2.1 billion, mostly tied to those expansions. They're ramping fast with the first 100 megawatts at Polaris Forge already online and generating revenue, and more phases coming through 2026 and 27 to hit over 900 megawatts in the pipeline. Now, the bear side, because I promised balance, they're still not profitable. Net income was negative 17.5 million in Q2. Execution is a risk. Building these beasts isn't easy. Delays or costs or overruns could bite hard. Now, insiders have sold over $20 million in shares in the past 6 months, including the CEO and executives, which raises eyebrows, though with the stock up 270% in the last year, profit taking kind of makes sense. And they're up against giants like Equinix or Digital Realty, who have deeper pockets. Now, my honest take, the insider sales are probably just cashing in after that run, not a massive red flag yet. Losses are from growth mode, pouring billions into facilities that are already paying off. Now, they've proven execution with phases live and customers paying, so I'm okay with that. In a market starving for AI compute, this isn't winner take all. Multiple players can thrive, and all 14 analysts covering this say it's a buy. For me, this screams a buy, at least as a small position in a much larger portfolio. Let me know what you think in the comments below, if you're actually in or out on Applied. Okay, so now let's talk about the last one. Next one is a little high risk. It's NVTS Navitas Semiconductor. This one's kind of flying under the radar for most people, but it's got real legs if you're betting on the same stuff that I am: AI power demands and the shift to more efficient chips. Now, Navitas makes gallium nitride, GaN, and silicon carbide power semiconductors. Now, these things convert and manage power way better than old silicon. Less heat, less waste, and faster everything. Now, that matters a lot for EV chargers, solar inverters, and especially AI data centers that are sucking down insane amounts of electricity. They're based in California and went through a SPAC back in 2021, and right now the stock's bouncing around $10 to $11, and it jumped 15 to 16% a couple of days ago on some tech momentum, but it's been choppy, but it's still up decently to date. Now, the thing that got me interested was their collaboration with NVIDIA. Back in October 2025, they announced that they're working together on NVIDIA's new 800-volt high voltage DC power architecture for massive AI factories. Navitas GaN and SiC parts are designed to handle the grid-to-rack power delivery with way less loss. Now, that's not some loose partnership. It's their gear showing up in NVIDIA's reference designs for the next wave of Blackwell and Rubin clusters. Now, financials are still early stage. Latest quarter, Q3, reported around $10 to $26 million, depending on how you slice the segments, but down year over year because they're actually intentionally stepping away from low margin consumer chargers that they were involved in. Now, they guided Q4 low, like 7 million-ish, and as they pivot hard into AI and EV infrastructure, it's going to be a little choppy. Now, in the latest quarter, income was negative 19 million. So losses are there, but they've got over $150 million in cash with only 8.4 million in debt. Analysts are split, but leaning bullish long-term on this stock. It's definitely early on this one, so more risk, but I like it because AI data centers are going to be power monsters. We all know that. Downside is obvious. They're not profitable yet, and the pivot is costing them short-term. Revenue's been inconsistent, and big dogs like Infineon, onsemi, and Wolfspeed are in the same arena. Now, if AI spending pauses or they fumble execution, this thing could easily slide back to $5. It's volatile. It's down 40% from last year's high at one point. Now, for me, this is the higher risk piece of the 40K bucket. I'm putting 7K in because I want exposure to the power side of AI without going overboard. Now, if they start announcing real traction from the NVIDIA collaboration and revenue starts reflecting next year, I'll probably add more. But right now, it's a measured swing on something I think could surprise people. So the bull case is that the NVIDIA partnership fuels adoption, revenue doubles or triples in a couple of years, stock hits 20, 25, and the bear case is that the pivot takes longer and stock drifts to say $5. But I'm leaning towards the upside, and I think it's worth the ride. So again, let me know what you think in the comments. Is this stock a sleeper or is it too speculative? Drop your comments down below. So that's the 4 picks. Now, thanks for sticking through this video. 40K is real money, and I will reveal in the future how this goes. And also stay tuned for my safer long-term portfolio ideas and my growth plays in some of my larger portfolios coming soon to the channel. Thank you very much for tuning in, and have a great day.